Hey, what's going on guys? It's Martin here and welcome back to another video where today we're going to be talking about the difference between short-term and long-term investment. So in the last couple videos we went over how you can put your money into the stock market for long-term growth and make tons of money. And in my most recent video we actually went over 3 specific ETFs or exchange traded funds that you could actually invest in and make a lot of money in the long term. But in this video, I want to go into specifically how we can trade for short-term growth and long-term growth. Now to get started, we have to figure out what your goals are. Now, if you have a little bit of money that you want to grow really quickly, that's considered short-term growth. And if you have a set amount of money that you want to invest every month or however long incrementally you want to do that and then have it grow in the long term, obviously that's long-term growth. Usually for a beginner, I like to recommend a mix of both. Personally, I have a set amount of money that I invest month to month to long-term stocks, and then I have a little bit of money to play around with set aside for short-term growth to make a lot of money really quickly versus a lot of money in the long term. So I'm going to go over long-term growth first since it's super simple and there's not a ton to get into. The way I recommend doing it is by going through ETFs like we talked about in the last video. The 3 we went over were VOO, SPY, and SPXL. Now these are 3 of my favorite ones to recommend because they have pretty solid growth over the last couple of years, and they're those stocks that you can put your money into and not worry about a ton in the long term. Now obviously when you're looking at long-term growth, every day your stock can go up or down, or every month it can go up like crazy and then down a crazy amount, but your goal is long-term, a year or more. How long is it going to grow in that time? Contrastingly, if you're looking for short-term growth, it's putting a lot of money in at once, grabbing it all out at the same time and hoping that you grow. It's much riskier. The reason I like to recommend long-term growth for beginners is because it's super safe. You know your money's most likely 99% of the time gonna go up. Almost 100% if you're going like for super long term, the stock market will go up. Even with a year like 2020 where we had a huge crash in the stock market, it recovered very quickly in terms of, you know, how long everything took to come back to normal. And we're still not really normal, but we're at least still growing based on the past numbers. And this year we've actually set records for highs in the stock market that have caused these ETFs or things that we've gone over to go up exponentially, even when we had huge losses last year. So focusing a little bit more on short-term growth now, there's a couple different things you could take a look at. One of the riskiest things you can do is take a look at meme stocks.
Me and my son. Hit it.
Now, I know that term sounds a little weird, but meme stocks are everything that you see in the media, on Reddit, Twitter, all of the things on social media that you see that promote a certain stock. Good examples of this would be GME, or more recently Dogecoin. Now I've invested in both of these just for fun, and I've lost some money and I've gained a lot more money. But I was a little more fortunate than some of my friends. I know a lot of people lost a ton of money on those stocks. No! So while I was fortunate, I know a lot of people that were not. So usually I try to warn against those short-term stocks. Now, sure, if you have money to spend and you just want to do it for fun, go ahead.
Money.
There is a huge potential for gains, but it's so volatile that you could also end up losing all of your money. Another still super risky way to invest, but that is a little bit more reasonable than meme stocks, is penny stocks. A penny stock is any publicly traded stock that trades below $5. That's kind of the widely accepted rules. Penny stocks are categorized as things that are being super volatile and hard to kind of leave a lot of trust in because they can go up like crazy, but they can also just as easily go down. So I trade a lot of penny stocks. I sometimes trade some meme stocks, but I try to stay away from them as much as possible and focus more on penny stocks and long-term growth. The reason I personally look at penny stocks more so than meme stocks is because penny stocks actually have something to back them. Now, I'm not going to say any specific names. Now, I do have a pretty long list of certain names of, you know, penny stocks that I would tell people to look at in this current moment, but I'm not going to throw out any names in this video. Just because if you're watching this more than a week out from when I posted it, all of these are probably not going to be as accurate as they are now. Again, these are meant to be short-term growth stocks. Now, you can invest a lot of money in something really small that you believe will grow in the future, but again, that's a lot riskier. When I personally look at a penny stock that I want to invest in, there's a couple criteria that I look at first. I look at the earnings of the company. So how much money that company is bringing in, but more importantly, what that company is doing. I've been recently taking a look at a lot of medical stocks or medical associated stocks. For example, there's a company, I'm not going to name it, but they are creating a device that is supposed to heal pain. So in short, it's supposed to replace opioids and other pain relief medicines that can be addicting. Now, on surface level, that's a great product. I mean, that's a huge market. There's a lot of people that experience pain. There's also a huge amount of people that try to avoid things like opioids or other addictive drugs that would reduce pain so they don't accidentally become addicted to them. So if a company comes out and says, hey, we have this product that will take away that pain, that's obviously a huge market. Now, that on its own is not enough to make me want to invest. After that, I take a look at, okay, this is their idea. What have they done to make that idea actually reality? So this company I'm talking about, what they've done is they've made a prototype. They've made multiple different versions of this device. They've tested it, and they're actually in the process of getting FDA approval and getting this in actual hospitals to test on real patients. So now we see that this company has a product. They're throwing it out into the world, getting it tested, getting it FDA approved. So there is some truth to this company, to this idea that they have. So in short, look at the company, make sure it has some sort of future that it's working towards. Now, going back to that earnings side of things. So the company has a product and they have some sort of income that is substantial. Now, when we say substantial, I have some criteria for that as well. I actually look at the earnings and I look at their debt. So how much money has this company borrowed and how much money is it bringing in? And then the third thing that I look at is how much cash they have on the side. So let's use imaginary numbers for this pharmaceutical company that we're looking at. So they have a device, they've created it, they've used beta testing, they've gone out and gotten FDA approval, but they have $1 million in debt. Okay, they have $1 million in debt, but how much money are they bringing in? Let's say every year they're bringing in $2 million a year. On top of that, they have $10 million in cash reserve. So this company has $10 million in reserves. They have $2 million coming in every year. So any given year, they probably have about $12 million, if not more, if they're saving a lot of that. And then they have $1 million in debt. So I see that yes, they have $1 million in debt, but their cash reserves are enough to cover that plus more. So if worse comes to worse, this company goes under and they can't do anything anymore, at least they can pay off their debt. Now, if we were to rework that situation and they still have that same $1 million in debt, they're only bringing in $100,000 a year, and they only have $500,000 in actual cash or assets. If worse comes to worse and everything goes under, now they have this looming debt over them. So to me, I always look at companies that are cash positive, that have room to grow, and then don't have as much debt as they do cash on the side. This makes sure that if worse comes to worst and everything goes south, this company is not going to completely fail and the stock price is not going to plummet. Most of the penny stocks we're talking about are usually $1, $2, $3, $4, and they could go up to 8, 12, and more than 10 times your money, or they could just as easily go to zero and you could lose everything. So if you're looking at short-term growth, my biggest advice is use money that you are okay losing. It's like going out and buying a lottery ticket, but with a little more research. Now, I'm not doing anything revolutionary. This stuff has been talked about for years, but I'm trying to get it accessible as information to people my age, or people that are a little older than me, or anyone that just doesn't know a ton about the stock market. So, in short, long-term growth is much safer, it's easier, you just throw your money at it and it will grow 100%, and your rate of return is usually very, very high over the next coming years. Now, short-term growth is very, very risky, but there are some things that you can do to kind of look at your companies and make sure they're worth investing in. Now, I do have a long list of things that I could recommend for short-term growth, and I've actually seen gains in most of the companies that I invest in. Now, I do have a bunch of stuff that I could go into and we could talk about in the future. I can show you the past of some of the things that I've invested in to show you that this is a viable option. But another thing I want to touch on is that you shouldn't put tons of money in some sort of short-term growth stock. Now, if you are a more experienced investor, do it. I sometimes do it if I'm really, really sure about something or I really want something to work out. I sometimes invest way more money than I should into something and hope that it grows. But for 95% of the people watching this video, I definitely do not recommend putting a ton of money into one specific stock and hoping that it will grow. Your money is much safer somewhere like a ETF growth stock. With that being said, If you are more experienced, I have been on the stock market for about a year, and I'm starting to take a few more risks than I was when I first got started, and I'm still seeing some losses. Now, overall, my account is very cash positive, but I have seen some losses across the way. The biggest thing is not to be discouraged by your losses, because it's natural. The stock market will go up and down. Your goal should always be buy low, sell high, but obviously that's not always the case. Sometimes you will buy high and then sell low, but it's important to remember that overall your goal should be long-term growth. Anything in the short term is usually temporary. Meme stocks don't last forever, so don't invest a ton of money into those unless it's like, super snappy, and even then I don't want to get into it, but there's so much specific stuff that you should be looking at before you invest in these meme stocks that I could cover in a whole other video. But for today, I think that's all I'm going to talk about. So I'm going to leave my videos up here. This top video is going to be my last video where I go over how to actually start your investing account. And this bottom video is my first video about the power of investing and how your investing can get you your dream car. So yeah, remember to like, comment, and subscribe if you guys enjoyed the video, and I'll see you guys soon.